Hi folks, welcome to this video on accounts receivable, and we've incorporated some ratios into the question. Now we can see here that we have some information available for Lando Corporation, and they follow ASPE, and this is at the end of 2009. During the following year, we can see that we have some credit sale transactions. We can also see here that they exchanged an account receivable for a note receivable, and we're given the interest rate on that note receivable. So we have a short-term interest-bearing note. So we should be thinking that because they're giving us an interest rate, maybe we might need to do an accrual. After all, we are at the end of June, right? When the note was made, and at the end of December we might have to accrue some interest. Lando collected some of their trade accounts receivable during the year, and there was also a sales return and allowance transaction. So again, the fact that they're following ASPE, we did take in the chapter that there's a specific way we would record that, and we also know that the allowance needs to have a $3,500 balance. So clearly they're using what they believe they need to have based on an aging schedule they might have done, with the balance in the ending allowance needs to be. So you're going to have to top whatever you calculate in there to that balance. Now, here we are at the end of 2010, and we have some ending balances for some of our current accounts, cash, inventories, and our current liabilities, accounts payable, and $16,000 for other current liabilities. Those could be accruals, those kinds of things. What we want you to do is to make the journal entries for 2010 and then calculate a current ratio and an accounts receivable turnover ratio. Now, don't forget, the formulas will be given to you, so don't panic. This is a little bit of what we did in our course, but largely a review of CB 101. And then what we wanted you to do is to comment on Lando's liquidity, given that the receivables turnover ratio last year was 4.75 and the targeted collection period was 65 days outstanding. So Lando wanted to speed up its collectability on their receivables to reach 65. Did they achieve that or not? We'll see. Or maybe they did better. Anyway, let's go look at doing the journal entries first. So again, if we go flip back to the question, it said that we had total sales of $465,000. $215,000 were on credit. So we know the balance were cash sales. So we're going to debit cash and the receivables and credit our sales revenue. We also know that during the period we exchanged our account receivable for a note. It was $50,000, so we set it up. We also know that we had collected on our receivables $160,000 during the period. So we're going to debit cash and credit our accounts receivable for $160,000. Now we also know that we had a sales return and allowance during the year. So because they follow ASPE, we are going to debit that account for $2,000 and credit our contra account to the accounts receivable. This is a new contra account we studied this year, allowance for sales returns and allowances. And this is specific to ASPE, right? They use this account. Now at the end of the year, we know that we had to accrue some interest, because if you read ahead in the question, you do have to calculate a current ratio and the receivables turnover ratio. So to get your current ratio, you need to make sure that you know all of your current asset accounts at the end of 2010. This would have been an amount that would have been a current asset account, because we need to calculate the amount of interest receivable and the amount of interest revenue that we're going to record when we accrue it on the note. So we know the note is valued at $50,000, 11% interest, and we're calculating interest from June the 30th to December 31st, and that's going to be 6 months of 12. Don't forget, your rates are always annual. So we needed to remember to accrue interest at $2,750. We also know that our allowance account needs to be set at $3,500. So what we might need to do is calculate how much is in it right now. Well, in our question, we can see that the allowance balance sitting that you've got now is $2,500, but if you need to have $3,500 in it, what you need to do is you need to go back and you need to debit the bad debt expense and credit the allowance to top it up to $3,500. So we need to make an adjustment of $1,000. Now we're going to use what we did in 2010 and some of the end of the year balances at the end of 2009 to calculate our current ratio. Now you guys know that the current ratio is current assets divided by current liabilities. Well, if I go in and figure out what are my current assets at the end of 2010, in the question we give you some information to help you do that. We've given you cash and we've given you inventory. So if we calculate it at the end of 2010, there's your cash and there's your inventory. However, don't forget we have to add in the numerator the interest receivable on the note, and we've also got an amount here of $42,000. That's our accounts receivable at net. So how did we calculate that? Well, let's go down here to a little t account I made, which gave us our opening balance of accounts receivable. That's from our question, because if you go back here, you know that we started our receivables at net at $40,000. So what happened during the year to adjust our receivable? Well, at net, don't forget our first transaction recorded accounts receivable of $215,000. We also know that we exchanged a note receivable or an account receivable for a note receivable. So we debited the note and credited the AR. That's represented here. We also know that we made a collection of $160,000 on outstanding accounts receivable, so that credits or reduces that AR balance. And we also know that during the year, we debited a sales return and allowance and credited the allowance for sales returns and allowances. Don't forget this is a contra account to the accounts receivable account, so it will reduce the AR balance at net by $2,000, which is what we have here. We also had to credit our allowance for doubtful accounts to adjust our allowance from $2,500 to $3,500. At net, that reduces your accounts receivable balance. So if we total the debits and total the credits, we see we have $255,000 in the debit column and $213,000 in the credit column. So at net, that's giving us $42,000. So that's the amount here that we have for our accounts receivable at net. Now, the $50,000 that you see here would be for your note receivable that you created during the year when you exchanged the account receivable for the note. So that balance is here. So now, if we take this numerator that we've calculated and divide it by our denominator, which is our current liability for balance for the end of 2010, and we've given you that information here. We've told you that your accounts payable and your other current liabilities were $70,000 and $16,000 respectively. So we can use that here and find that our current ratio is 2.241. Now, how does that compare to 2009? Well, fortunately, we're given all of our current asset and current liability information at the end of 2009 right in the opening balances from the question. So let's go back up to the top and see what we've got. We've got here all your current asset accounts here and all your current liability accounts. So 20 plus 40 plus 85 is right here in our calculation. 20 plus 40 plus 85, and these are the current liabilities. So if we do the math in the numerator and the denominator, you can see we had a current ratio last year of 1.813. So this year we're doing significantly better at 2.241. And whenever you improve, it's never a bad thing when your current ratio goes up. The only issue is here, did it meet our target, right? So we have to consider that. Is that what we expected or what we hope to achieve? Now, we weren't asked specifically to address that in our question, but let's first of all, before we do address whether or not this is a significant enough difference, let us calculate the accounts receivable turnover ratio. And that looks at your net credit sales divided by your average receivables at net. Well, your net credit sales we know are $213,000. How did we get that? Well, if you go back to the journal entries that you made here, you knew that your net credit sales, your sales revenue in total was $465, of which $215,000 was on credit. So that 215,000 is part of your net credit sales here in the sales revenue, right? However, don't forget your sales return and allowance is a contra account to the 215,000 that's part of this 465,000. So 215 in here less the 2,000 in here is going to give you net credit sales of 213,000. We're going to divide that by our average accounts receivable balance at net, and we know that our receivables at net in the question started off at the end of 2009, i.e. opening 2010 of 40,000. And don't forget, we used our T account to get the $42,000 balance at the end of 2010. The average would imply take those two balances and divide by 2. And so when we take this numerator, divide it by our denominator of 41,000, we're going to get 5.2 times. So that means that we collect receivables 5.2 times on average during the year. Now, how many days are our receivables outstanding? You remember that meant that the number of days that our receivables would be outstanding, and again, you did this in your studies in CB 101, you would have calculated 365 divided by the accounts receivable turnover ratio to give you 70 days. So it's taking us now around 70 days to collect our receivables. So now, let's go back to what our requirements were. We've completed A, we've completed B. Now we have to comment on the liquidity situation, given that we expected we had a turnover ratio of 4.75 last year, and we were hoping to have our targeted collection period for receivables be 65 days. So let's go look at our data so that we can comment on these items. So now let's have a look at the theory part of it. As we said before, the current ratio is improving. It's 2.241 this year as opposed to 1.813. So it's improving. If we look at the turnover, it's 5.2 times, which is higher than it was last year. So we are making improvements. We've improved over our last year's turnover of 4.75. It's now 5.2, so it's higher. And with this turnover, that means that we're collecting more frequently than we did last year. Now, even though our current ratio is higher, Lando is collecting receivables at close to the same pace, because now what we're seeing is that our receivables are 70 days in receivables, right? As opposed to 77 days in receivables. So in this case, even though we are collecting our receivables faster, where they're only 70 days in AR, right, versus what they were last year, which is 77 days. So again, I'm doing a calculation here to show you how I got 77 days. I know that when I'm calculating my day sales that receivables are outstanding, right, it's 365 divided by my turnover ratio. This turnover ratio was given to you in the question. You didn't need to calculate it. But we can see that my receivables again in 2010 are only in receivable 70 days, whereas here 77 days. So I'm getting better, but I'm not good enough. Why? Because my target was 65 days in receivable. So I really wanted to collect 65 in 65 days on average, not 70 days. But I am better. I am better. So things are looking up. So hopefully this video has helped you to see how we can do journal entries for receivables and use a lot of the data that we use when we record our journal entries to calculate new balances and help us calculate ratios which we can interpret.